Oil hit $114 a barrel on Monday, the highest since the early days of the Iran war, after Iranian forces struck a UAE port and the ceasefire that held for 4 weeks collapsed in a single afternoon. The contradiction that demands explanation is this: Iranian oil revenues have actually risen since the war began, even as US and Israeli strikes pounded its infrastructure. Volume fell, but prices rose fast enough to more than compensate. Tehran found a workaround. Chinese refiners, operating under a formal Beijing directive that prohibits compliance with US sanctions, kept buying. China's Ministry of Commerce invoked its 2021 blocking rules for the first time, instructing 5 state-linked refineries to ignore Washington's designations entirely. The result is that the financial pressure the war was supposed to deliver has not materialized on Iran's side, while the rest of the world absorbs the supply shock. The Strait of Hormuz has become the central mechanism. Iran effectively closed the strait to vessels from Kuwait, Saudi Arabia, and the UAE after hostilities began. A fifth of the world's seaborne oil now cannot move through its normal route. The U.S. Navy launched Project Freedom Monday, sending guided missile destroyers through the strait to escort 2 U.S.-flagged merchant ships. It was the first successful American commercial transit since the closure began. But naval escorts do not reopen a shipping lane. They demonstrate that it remains contested. UK airlines are already warning of summer fuel disruptions, and Spirit Airlines attributed its shutdown directly to wartime jet fuel costs. The UAE's response was not military, it was structural. On May 1st, the UAE resigned from OPEC, a decision its oil minister described as a sovereign repositioning, not an act directed against anyone. ADNOC, the Abu Dhabi national oil company, immediately announced it would accelerate $55 billion in upstream and downstream investment over the next 2 years. The UAE also withdrew from OPEC. The message was that Abu Dhabi intends to grow production and export capacity on its own terms, outside cartel constraints. For the global supply picture, this is a supply-positive signal, but it takes years to translate into barrels, and the strait disruption is a problem measured in days and weeks, not quarters.
The oil surge that is crippling oil-importing economies is producing a different kind of problem for Canada, one that reveals how deeply the country's policy machinery is divided against itself. The Bank of Canada held its benchmark rate at 2.25% Wednesday. Its statement acknowledged that higher oil prices have increased national income for Canada as a net oil exporter, but simultaneously warned that consumer gasoline costs are rising, headline CPI will likely reach 3% in April, and long-term growth remains constrained by U.S. tariff uncertainty. The bank left rates unchanged because it faces 2 simultaneous pressures pointing in opposite directions: an energy price inflation risk that would normally argue for tightening, and a tariff-driven manufacturing slowdown that would normally argue for easing. That structural tension runs deeper than monetary policy. Prime Minister Carney committed last fall to negotiating a strengthened industrial carbon price with Alberta by April 1st. That deadline passed without a deal. Oil sands producers are now pushing back openly. Canadian Natural Resources CEO Scott Stouth said companies investing in carbon capture should not face a carbon price on top of construction costs. The Pathways Plus Carbon Capture Project, a $16 billion commitment that was central to Carney's climate credibility, is unlikely to proceed at full scale. A smaller version remains possible, but the flagship has stalled. The Iran war strengthened the hand of producers who argue that global demand tightening justifies production growth, not emissions constraints. Ottawa's response to the tariff pressure came separately. A $1.5 billion loan package announced Monday for steel, aluminum, and copper producers hit by expanded U.S. tariff measures. The federal government has also committed to releasing 23.6 million barrels from domestic producers in coordination with the IEA's global oil release, a move that positions Canada as a reliability partner in global energy security, which conflicts directly with the carbon reduction targets that same government has staked its climate credibility on. The IEA chief is visiting Ottawa this week, and his message that Canada should accelerate new energy infrastructure as markets shift adds institutional pressure on Carney to prioritize supply over emissions timelines.
The clearest market signal from the Iran war may not be in crude at all. Cameco's chief operating officer, Grant Isaac, made a direct historical comparison in an interview this week. More than 40% of the world's currently operating nuclear power plants were built in response to the 1973 oil embargo. The current Middle East conflict, Isaac argued, creates the same structural incentive, and this time it combines with AI-driven data center power demand and national security concerns about supply chain energy independence. Uranium demand is already projected to triple by 2040. Global consumption already outpaces production by 50 to 60 million pounds per year, according to World Nuclear Association data. RBC capital markets analyst Andrew Wong described momentum in nuclear new builds as accelerating. The gold market tells the other side of the same story, and it is contradictory. Spot gold fell as much as 1.8% Monday to just above $4,500 an ounce, extending 2 straight weeks of decline. Gold has lost 13% since the start of the Iran war. The conventional logic says war drives gold higher, but this war has driven oil higher, which has driven inflation expectations higher, which has made central banks less willing to cut interest rates. A non-yielding asset like gold suffers when rate cuts get pushed back. TD Securities head of commodity strategy Bart Malak called it hawkish signaling compounded by Hormuz uncertainty. Goldman Sachs and JP Morgan maintained 2026 price targets of $5,400 and $6,300 respectively, both substantially above current levels, but the near-term path runs through peace talks that remain stalled. Trump has publicly rejected Iran's latest proposal as insufficient. The weight of evidence points towards sustained energy-driven inflation pressuring both rate expectations and gold recovery, with nuclear as the structural trade that bypasses that contradiction. But this only holds if Hormuz remains contested. If the U.S.-Iran talks produce a deal, and Trump's letter to Congress declaring hostilities have ended after April 7th suggests a formal off-ramp may have been signaled, oil retreats, rate pressure eases, and gold's long-term institutional buyers reassert. The verification benchmark is oil's position relative to 100. Above that level, the inflationary pressure on central banks remains acute, and the nuclear thesis strengthens. If Brent falls below 100 in the next 2 weeks, the rate cut calendar reopens and the entire picture shifts. The condition that would prove this analysis wrong is a ceasefire announcement before Hormuz transit is formally restored, because markets would re-rate the supply risk faster than the physical reality would warrant. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.